All right, thank you very much. So we are recording this, and if you have questions, we will have a Q&A section at the end. In the meantime, if you'd like to send Daniel questions in the chat, please feel free to do so, and we'll make sure that we get those questions answered. And we do love questions, and you'd be hard pressed to offend us, so don't try to be delicate, okay? The reason that we're doing this, just so that you understand, unlike from what I can see, any of our peers across the country, we've come to find that there are a lot of people, for various reasons, are suddenly looking like deer in the headlights about the outcome of this election. They just know in their brain that this one's going to upend life as we know it, the markets as we have ever seen it, and the economy. This is it, okay? They just know this. So that for us, that became an opportunity to say, hey, we want to get a little ahead of this. What do they say about fear? Great academic, false evidence appearing real. So one of the things that we're going to do, I'm going to ask you to think like we're in the library. Okay, we're on the bus. We made it to the library class, and here's what we're going to do. We're going to rope off the fiction section, the science fiction section, and we're going to spend some time in the nonfiction section. Okay, we're going to deal with the facts, not my thoughts. We're going to look at history. You know, we don't have to repeat history. We might be able to learn from history, and it might be appropriate, and we thought it was, and we're glad you agree, for us to kind of look at history from the standpoint of all the times that we've gone through elections, and there have been many times where it has been very dramatic, let's put it that way, and yet things came together. So we're going to look at it from the standpoint, it's not about the R or the D. We're not looking at the blue or the red. We don't care. We're looking at what happened after the election to the economy and what happened to the stock market. That may give some of us the facts a little, way to kind of hold back the fears, to rein in the fears, at least to put them in a position where they don't just inflame us and make us go crazy. And then what we're going to do, because who knows, I can't see the future any better than you, where do we go from here? One of the things that I've only been in the securities business since 1979, and one of the things that our peers are, I'm going to say, notorious for is we tell you, I think it's now an insult, you have to sit and take it, okay? You have to take the losses. You have to live with the losses. So once we get through the history, we're going to talk about what we do to help investors see they don't have to live with losses. They can limit losses, and we'll show you some evidence there. So let me give you a little background here about who we have in store. As I say, I'm John Grace, your host who loves you the most, president, founder at Investors Advantage, licensed in securities and insurance since 1979. We have our main math man, that's Daniel Medina. He's a Cal Lu grad. Daniel's really good with math. I mean, I have 3 HP 12Cs. I think he has 1 because he can do most of the math in his head, and I'm still worried about the words. So I worry about the words, he worries about the math, and we bring things together. Daniel is a Cal Lu grad, and before he associated with Investors Advantage in late 2006, he was employed in both the mortgage brokerage and real estate. So he's got a very good background. And again, he's really stellar at math and putting things together and making all the technology work, okay? And then we're really delighted to have a special guest, Noah Howard. Noah, raise your hand so people can see who you are. Now, this is a really smart guy. He passed this test I won't take, okay? It's a certified investment management analyst. The last test that I took was to be master certified with Dent Research. I want to point that out because the securities industry, for the most part, what do we talk about? What the hierarchy tells us to tell you. And let's just be honest, when you have stocks and exchange traded funds and annuities and all these different products, the hierarchy is giving us every reason they can think of to stuff you with X, Y, and Z. By paying for independent research where they're not selling anything, it helps us get a better perspective of how the economy is really working, to look at and study the buying and selling behavior based on age. No one does that. We're all looking at the sales data. It's the age issue that most people don't focus on, and it drives everything. So, yes, glad that Noah could be with us. Now, Noah in his checkered past was at Fidelity and TIAA-CREF. I point that out because he has a perspective of some of these companies that spend lots of money to get time in your head, and then you think you know them because they've spent so much money getting time in your head and then he became associated with Clark Capital. And just so happens, Clark Capital is one of those firms. We're glad they do not advertise because you know who pays for those costs. All right, you do. And I happen to know the founder of Clark Capital, along with his sons, is a family-owned business. I believe they started back in 1986. And I want to make this point. The office manager at that time, and I looked closely at Clark Capital after meeting Harry, was very impressed with their work. We decided not to do business with them at that time. This is late 1999. And then we discovered after we saw the first 50% loss, remember there was not one but two in the same decade, the returns that Clark did better than all the other companies we were doing business with. So we had to revisit Clark Capital, and that's when we started working with them. And now we see that their cost structure has been reduced and the work that they do has been improved. So we're delighted that Noah could be here representing Clark Capital, and he's the one who's going to help us go through our history lessons. All right. And just so that you know, let's see, make sure I mention this. Clark Capital is an independent asset management firm providing institutional quality investment strategies to individual investors, corporations, foundations, and retirement plans. Among its many awards, with over $28 billion entrusted to Clark Capital, the firm just, I believe, last week was recently awarded Asset Manager of the Year. I believe this is the fourth out of five of the past 5 years by the Money Management Institute and Barron's. Like I said, you may never heard, now you have, but I mean, that's quite remarkable. So here's what we're going to cover. As I say, if you got in a little bit later, we're on the bus. We just got off the bus. We're at the library, and this is back to school time. It's the National I Care About You Day. And you remember the library, but we're going to avoid the mystery, the science fiction, the fantasy, and the fiction. All those areas will be cordoned off. We're going to be in the nonfiction section to separate fact from fiction by studying your favorite subject, of course, and that would be history, along with geography, right? Now, from 1789 to 2020, there have been 59 presidential elections. And as you will come to see, people care about elections, but markets don't. All right. So once when we can learn from history as opposed to repeat history blindfoldly, blindfold it, there we go. Maybe we can breathe and smile and be thankful that we're here to see what's going on, and we can pay attention and be agile. That's crucial. Agile in our bodies and our minds, and also in our investments. Don't let the account get static. Give it the attention that it deserves. Make sure it moves the way you want it to move. We'll get into that. So as we say, people may care about elections, but markets don't. And Daniel, if you could please, let me ask a question. What do you all imagine? You can raise your hands, please. Which president had a better stock market run? Was it Ronald Reagan or Barack Obama? By a show of hands, how many think it was Ronald Reagan on the left? You guys aren't playing along. Nobody? Okay. How many thought it was Barack Obama on the right? Oh, okay. You're doing better than most. Here are the results, because we like the data and we like the proof, okay? Most of the folks that I've talked to were shocked to see that they were convinced, absolutely, that Ronald Reagan had a great run. And he did. 207% cumulative returns in the time that he was in office. But Obama had a better time. And by the way, one of the things that people do a lot is, talk about how the president should do this, the president should do that. I was surprised to see that Clinton had the most growth in GDP, and some people would give Mr. Clinton credit for that. And you know who we give credit to it for? It has nothing to do with him. It has to do with baby boomers coming out of school, getting jobs, making the economy blow up to levels, including houses that we see today. So I'm going to use that as a way to introduce Noah because he's adept at going through history and, Noah, as you go along, please, what are some of the biggest questions people are asking about the economy relative to the election, and how does Clark Capital answer those questions? Noah?
Thank you, John. Appreciate it. I appreciate the warm and very generous introduction as well, especially coming from a two times winner from the LA Business Journal for one of the top leaders in Southern California. So thank you so much for that. I'm happy to be here. Let me share my screen, and then I can get into our content around what we're seeing in our investor pool. So bear with me as I am sharing here. Computer is saying it doesn't like that. Give me one more chance. And I have got this right here. Okay. Okay, here we go. So my name is Noah Howard. I am the investment consultant with Clark Capital. And John had mentioned that we're going to spend today going through real information, data, certainly our opinion of this data, but it's rooted in evidence and what we as an investment firm here at Clark are looking at on a regular basis. The title of this presentation is Your Top Questions Answered. And really what we go through here at Clark is we meet with, we have thousands and thousands of high net worth investors. Average household with our firm is over $3 million. And we get asked a lot of questions when our portfolio managers, our client relationship managers, myself, our investment consultants who partner with financial advisors like Daniel and John, when we're meeting with our end investors, they ask us pretty consistent questions. We compile them as a group. We send them to our main think tank internally on our client portfolio management team. And then we distill them into what are the most common themes that we're seeing on a regular basis from the people whose money we are managing, who are entrusting their financial well-being, at least in part with our firm. And this is going to be today's agenda. So we have last week, literally, I was with a client who was concerned because we kept running into all-time record highs in the equity markets and the stock market. And they just didn't understand why this would be a good time to continue to deploy capital into the stock market. Their concern was there's going to be a recession. This is something that we have heard for the last couple of years. Still lingering concerns around inflation. How is this impacting our ability to invest? What is the Fed doing around inflation? How is this going to impact our portfolios? I've also heard things, and we have as an organization, around government spending and the deficit, and how do we think through this in terms of from an investment paradigm. Ultimately, there's a lot of questions out there, especially with higher net worth investors around the bond market or the fixed income market. Should we be owning these? Should we be selling our positions, maintaining, adding to them, et cetera? And then ultimately, as John had mentioned, we'll close with the most salient of kind of timely topics, which is 11 days from now, we have this little election coming up, which have some implications, certainly, and we can discuss that collectively. So let's get into the actual presentation, the information. So when we look at our stocks too high, the first question that we always look at is the turbulence that we're facing abnormal in the marketplace? Because turbulence is normal, and the way that maybe we describe turbulence in the investment world is through volatility, which is the term that we like to dictate, that says, hey, what price movements are we seeing in the stock market, in the bond market, and are they abnormal? And we anticipate some fluctuations of prices, certainly in stocks over time, and certainly intraday, any given day, there can be large movements, certainly. And what we're looking at here, the blue lines represent, or the blue bars represent, the number of days where the S&P 500 has moved up or down by 1%. So relatively large single-day movements. The orange line is the average, and this is since 1990 through the end of September of 2024. And you can see here, we're at relatively normal levels. We still have a few more months left in the year, about 2 months really, and change. So this might creep up a little bit higher. Certainly it will But compared this to like the 1990s, late 90s, early 2000s, where we saw the dot-com boom and subsequent bust. The financial crisis here is kind of the middle part, and then COVID and inflation are the two other kind of outliers from a volatility standpoint. We're not today, at least at a juncture where we're seeing volatility or turbulence in the marketplace that is, one, abnormal, and two, these sort of days are expected overall. When we think about like how frequent of corrections or how often do we see price declines in the stock market, there's ways that we can quantify and look at it from a historical perspective. So what this chart is saying is, or illustrating, the S&P 500 again is what we're going to focus on. That's a snapshot of the 500 largest companies in the United States. It is certainly not all of the publicly traded stocks that represent the market, but it's a good snapshot, and I think something that most people are familiar with. The S&P 500 declines on average just over 3 times per year of at least 5%. So it is expected that we see on any given year at least 3 times where the S&P 500 has declined by a 5% reduction in value at any given point. If we get to this phase, out of those 3 occurrences, a little bit more than, about a third of them generate at least a 10% loss. So essentially every single year, it is normal for us to have not only 3 5% declines in the stock market, it's also very normal for us to have at least once a year, a 10% decline in stock prices, right? So if you have $1 million investment in stocks, every year we expect at some point that $1 million to depreciate down, at least on paper, to 900,000. If we are in this 10% kind of pullback period, about half of the time, those declines extend even further down to 15%. And the majority of those, slightly more than half of the 15% declines, reach at least 20%. And that occurs essentially every 3 years. We see a correction where that $1 million investment can lose at least $200,000 of its value, 20%, and potentially more over a 3-year period. So there certainly can be volatility. It is normal. We are not seeing, really even anything in the 5% or 10%, let alone beyond that, in 2023 and 2024. So we're living in relatively non-volatile times. When we think about what drives stock prices, so we're at these all-time record highs. We have a core belief, two beliefs really. Number one, on any given day, that the reason for a stock to move up or down can certainly vary. Sometimes it's rational, sometimes it's not at all. But over time, the second core belief is that the primary driver of the price movement of stocks is earnings. Like how profitable, how much money is a company making? And what we're looking at here is the S&P 500, that's the blue line, since 2000. And we've seen relatively strong growth in the S&P 500 over this 20+ year time frame. Overlaid to that is the earnings of the S&P 500 at 12-month trailing, that's hard for me to say quickly, operating earnings per share. I like to look at this a little bit differently, not just from a historical perspective, but kind of where we're going. What these blue bars are those earnings per share on the S&P 500 broken out by calendar year. So you can see last year, calendar year 2023, the last blue line here, this was a record year for corporate America's profits. Over $213 in earnings per share for these companies. And we're in the middle of 2024's calendar year, this orange bar. We're in the process of calculating third quarter earnings. We're getting earnings reports on a regular basis at this juncture. And we're also in the process of earning the final quarter of 2024. And by all measures, our expectation and what we've seen is that not only will we meet this expected earnings of $235 per share, but it actually probably will come a little bit higher this year overall once the dust has settled. So the reason why stocks are at all-time highs today, we would argue, is because stocks are generating more earnings than they ever have. Those are also at all-time highs. Optimistically looking into the future, our expectation is that earnings growth continues to trend upwards, with over 274. So a 16% growth from expected earnings this year. This is something that we look at on a regular basis. It certainly can change. There can be headwinds. We'll talk about some of those. But on the surface level, when we think about valuations of stocks, are stocks too expensive? We would argue no. They're not cheap either, but they're not expensive because companies are making a lot of profits, and the expectation is that that will continue. So if we shift into the economy, one of the big drivers that we're looking at is what's occurring in the labor market. The reason why the labor market is so important is not too hard to think through, but it's important to do the exercise, which is if people don't have jobs, they probably can't spend, right? So from an economic perspective, there's certainly a major implication if we start to see unemployment go up. Also from just a human perspective, right? We want to be employed. We want our friends, our family, our neighbors to have high quality of living. And one of the key metrics that we're looking at is the payroll expansion. So this is, this big spike down here. This is the massive amount of layoffs, historic layoffs that we saw as a result of the coronavirus pandemic and the global shutdown that we saw. So unprecedented times, certainly. And what we've seen since 2020 is a relatively strong, consistent growth in people finding work. But we have seen some moderation in terms of the amount of jobs that are being filled essentially on a weekly, monthly, quarterly basis. This is overall, though, relatively good news. So when we think of what we're looking at from the Fed, the chairman Powell and the Federal Reserve, they have this dual mandate of low inflation, a target of 2% inflation rate. We'll talk about inflation in a little bit. But on the employment side, they're targeting really about a 4% number. And so the expectation is that of the people looking for jobs, 96% of them, or 96% of people who are eligible and want work should have a job. 4% should be looking for a job due to just natural attrition, things along those lines. So that is deemed by the Federal Reserve as full employment. You can see we're pretty close to that. Back in the summer, I don't know if you all remember, we saw some volatility, some price movements pretty aggressively on the downside, and that was because largely some negative surprises in the unemployment figures that came out. I believe it was back in July of the summer timeframe. And really what we're seeing in the economic worldview is a shift from inflation to a focus on, can the Fed manage to not essentially force companies to create unemployment, which would ultimately result in a recession. Like that's the long-winded way of saying, can we maintain full employment? Is the Fed policy being effective? Can they get the soft landing? And back in July, there was a little bit of a scare here where we saw some of the unemployment figures creep up, and we've seen some moderation in those payrolls that we saw before, thus a pretty aggressive sell-off because there was some panic in that moment. We've since seen some more encouraging numbers, which is good. Certainly nothing like the middle of this graph, but if we can maintain this 4% unemployment rate, that's good news for not only the economy, but also ourselves and the people that we care about. When we look at what the employment picture looks like, we're still seeing, employers maintain their employees. It's still a very competitive job market where there are still more jobs available than there are applicants. That has come down than it was just a couple of months ago or a couple of years ago, depending on your measurement. But there still are more jobs available than people to fill those jobs. And even, I'm thinking of some of my friends who have been in the tech space. Like occasionally we see like a layoff that gets announced either in the Wall Street Journal or some other news organization. It's several thousand or several hundred people. There's a restructuring. Those are definitely not good moments for the people that are impacted. But when we look at it from a macro perspective at the national level, we're not seeing concerning trends of layoffs. So this is showing up in just the number of layoffs that are occurring are within historical norms, and certainly nothing abnormal like you can see obviously during the last recession, during COVID. Every time there's a huge spike, it seems to be 2020. So I might not explain every single time, but today where we're at is relatively strong. So why is that important? Well, when we look at our GDP, gross domestic product, of the country, 70% of the GDP is based upon U.S. consumers. So our ability to go out and purchase things drives the majority of the economy. That is why we look at this information from an investment perspective on a regular basis. What's on the screen here is just the health of the U.S. consumer. The blue line is essentially like how much cash and income are people generating on average as a country. We have $22 trillion of essentially income being generated. Our expenditures are under $20 trillion. So these numbers are massive, right? Like I can't even comprehend how big that is. But the key here is that we are generating more income than we are spending as a nation. That might not be true for an individual's experience. Certainly, some people are not living in that, and there's a variety of different reasons, and that certainly can be troubling. But overall, from a big macro perspective, there is a buffer between our income and our consumption, which is good. Also, a sign of a healthy consumer is travel. COVID obviously wrecked the dark blue line. It really impacted the way people were traveling. What we're looking at here are TSA entrants, people who are going through, the TSA system to get on an airplane. And then we've slowly seen these numbers recover. The red line is 2024. So we're at all-time highs in terms of passengers that are going through checkpoints at airports, assuming they're all getting on airplanes. And we're above our pre-pandemic levels, which is this green line. So very encouraging news from just the health of the consumer, which again is so important because our consumption drives so much of the overall economy. Oftentimes we'll be asked, well, what about liabilities? I hear we're at $1 trillion in credit card debt, which is true as a country, not ideal. That's this blue line here. This is the amount of liabilities essentially that individuals are holding on their balance sheets in the form of debt. What often isn't talked about is the amount of cash that we have as a country, over $4 trillion in assets that are on the balance sheet in terms of cash or cash equivalents. So very, very massive difference between this blue and green line, which again is a very good indicator for the health of the U.S. consumer. Most people in general have a lot more cash than they have credit card debt. That is certainly not true for everyone. But when we look at it across the country, that is certainly what we're seeing. That has not always been the case, right? There are periods like the global financial crisis. One of the biggest issues that we faced during the financial crisis was the extension of debt and the collapse not only of the financial system, but the collapse of the individual and their ability to pay their obligations. We're just not seeing that in the data right now. The red line, this is less important to me. It's the amount of available credit in credit cards in particular. I don't necessarily, this number to be high is good. It just means the consumer has access to a lot of debt. Obviously we don't necessarily encourage debt spending from an investor perspective. So I alluded to this a little bit for 2008. Like this is what we're looking at here is how reliable are individuals paying back their debts. And the financial crisis here was the all-time, at least in our lifetime. Maybe if we went back to the Great Depression era, that would probably be the data might be worse than financial crisis. But we saw a very, very difficult time for individuals, even institutions paying off their debts. It was a very difficult and frankly scary time from an investment perspective, as well as just are we going to make through it? And we've subsequently come through that. 15 years or so removed from the financial crisis. And we're in a position where we're starting to see a little bit of tick ups in some of the delinquency rates on some consumer loans. Certainly nothing in the mortgage world that's concerning. But overall, the health of the U.S. consumer, again, when we look at are people on average able to pay off their debts or at least make their payments on time? The short answer is yes. That's what we're seeing with a couple of upticks in some of the stress that investors or consumers are feeling. So let's talk about inflation. So we have, from our perspective, stocks that are relatively valued fairly that I think we can justify all-time stock prices. We have an economy largely driven by the labor market, which is probably the number one indicator that we're looking at that seems relatively healthy, at least as an average, maybe not again on individual bases or even subsets within that overall average. But the big number that we've been dealing with really since 2022 has been around inflation. And this is important, right? Like people consuming is, as I mentioned before, is 70% of the economy. And if we can't consume a broad, diverse basket of goods, that's not a good thing for the economy. And it certainly wasn't, especially in 2022. The good news is, as measured by the key indicators by the Fed, inflation has moderated very a lot, I should say, since 2022. So this blue line, this is the consumer price index year over year. This is usually the data point that most newspapers are going to publish because it's very volatile. It includes things like utilities and food, which are very volatile. The red line is the same data, but without those two components, which the Fed likes. So in case you don't use electricity or eat, we've got this red line as our data point. Really, the reason why the Fed uses this is because they don't want the volatility that essentially, like you can think through oil or just the inputs that go into producing food can create very volatile price movements both up and down. And the Fed wants to mute that to get more reliable data. And what we're seeing now, this red line, this is our inflation number. This is the one that they are looking at, is getting close to that targeted 2% level. It's not quite there. It's at 2.6, but really the Fed came out and said the time is now. We're moving on. We believe that inflation is under control. At least at this juncture, certainly they're going to continue to evaluate data as it comes in, but their focus has shifted away from inflation and towards the employment figure, at least from our perspective. They'll certainly look at both, but this dual mandate of full employment and low inflation at a 2% level seems to be they're shifting from inflation towards the employment side of the spectrum. And here's that based on graphs. And really the key indicator here, as we saw back in July, is if the Fed does not have the right monetary policy that enables businesses to have access to capital to maintain the payrolls that they have, or to invest in future projects or start new businesses, however that capital wants to be deployed, if it continues to be as expensive as it is, I think their primary concern is, does that impact this employment rate? Which, if we get to 6% unemployment, that's probably pretty bad news for everybody here. So that has been certainly their focus. And the tool that they have in their bag to get to 2% and 4% are the Fed funds rate. Right? Like this is a graph showing what they have done. You can see here on the left-hand side, this is the coronavirus popping up. We have that very fast recession back in 2020. Interest rates go to zero and maintain that level up until 2022, when we started to see inflation rearing its head due to, in large part, all of the government spending that we are seeing across the economy. And interest rates went up very aggressively over this year period. And then over the last 12 months or so, maintained a relatively high, just over 5% federal funds target rate. And essentially what this rate means, this is like the rate that banks lend to one another with the Fed overnight. And it drips into the cost of capital. So as this rate comes down, it should be cheaper for banks to operate and lend out money to either consumers who want a personal loan, or a business who wants to fund a project that they don't necessarily have the capital for, but they can have that cash flow to sustain the debt if the debt is cheap enough. And I think we've seen that probably in the most real life example is probably most people feel that in mortgages. If you're out purchasing or shopping for a new home, not only has the prices maintained relatively high, but the cost of the debt itself is higher than it was a handful of years ago. And that is feeding into this housing crisis that we're all facing. This policy here has influenced the price that banks are willing to lend out a mortgage. So as these rates come down, our expectation is certain types of debt services should be cheaper and thus be stimulative for the economy as a whole. When we look at the expectations, so our current target rate, so the current lending rate, the overnight rate is between that 475 and 500 basis points. That's 4.75 and 5%. The overall, like if you ask all the economists who survey this through the CFM Fed Watch tool, most of these individuals, 80%, believe that the rates will come down between 25 and 50 basis points by the end of this year, essentially. So the next 2 months, most pontificators think that there's a 1 to 2 cuts coming in, with a handful saying we're gonna stay relatively in line, maybe have 1 cut, with a few outliers saying no, we're definitely not cutting rates again before the end of the year. So the base case currently for the short term is more cuts coming this year, probably 1, maybe 2. If you draw that future out, this is to the end of 2025. What is the expectation? This is where you start to get a little bit more variance because of the amount of time, right? A lot of things can change. And I think if you're in the business of predicting what the federal funds rate will be in 12 months or 16 months from now, it's a hard business to be in. But it's important to understand what the trend is, not necessarily the exact timeline, and what that means for not only the economy, but also how we position and build portfolios. It's not so much the timing, it's more what's the directionality that is very important for portfolio construction. But most people in this space who are smart and understand what the Fed is doing believe that rates will end up likely in that 3 to call it 4% range. That's where most of this bell curve of expectation. So that's essentially saying 5-6 cuts on the Fed funds rate by the end of next year from today. And that overwhelming from our perspective is good news for investors, both in stocks and bonds. And the reason why I say that is, a lot of what I had just mentioned around it's stimulative for the economy, that's going to be reflected in businesses' profit, like the cost of capital will be cheaper, easier to have people employed, which means more consumption, and so on and so on. So there's a lot of impacts downstream that a lower rate environment has that's beneficial from an investment perspective. And what we see here historically is that there's only been 1 year, and I'm sorry that this chart is such a mess, but what we're breaking out here is the cycles where we saw the Fed cutting rates. What happened to the S&P 500? What was that total return? And essentially what we see is that every single period since the 1970s where the Fed has been cutting rates, every single period except for 1, we saw the S&P 500 appreciate in value in that time frame. That 1 exception was I would say there's other factors involved here, like this was 2001. So if we go back to 2001, this was the tech wreck collapsing plus 9/11, right? So we had these 2 very big components that were influencing the marketplace, and we had valuations on the stock. Like if I was showing the first part of this presentation from a valuation perspective, the valuations didn't make any sense. They were not based on profits. They were not based off of earnings. They were based off of a vision of the future, which occurs occasionally, certainly in investing. But once that bubble burst because there was no earnings yet for these companies, I think that's the large reason why we saw this exception here, was because it was just so frothy prior to the cutting of rates in this time frame. But aside from that 1 period, from a historical perspective, stocks tend to like rate cuts. So let's look at the debt. So this is one that's important as well. What we're looking at here, the S&P 500. So this is the appreciation of the S&P 500 of the U.S. stock market, or at least a portion of it over a 50+ year time frame. And the blue line is our debt to GDP ratio, and you can see we're at about 122%. I think a simplified way of looking at this could be GDP is like the country's income. I think that's probably a little too simplified, but we'll stay with it. And what we're seeing is the amount of income that we're generating, gross domestic product, the economic output that this country produces. We have debt that is 122% on that annual basis. not ideal, right? I think that is a fair statement for everybody, hopefully on this call. But it might not be as bad as we think. And the reason why I like to maybe compare it to income is like if you take out a mortgage, the first time you take out a mortgage, you might borrow, $800,000 on $1 million property. You That could be well above your total income, the $800,000 that you're borrowing that you have to service. But what matters is your cash flow. Can you service that debt? And what we're seeing is here we have again the same debt to GDP ratio, this 122, but the yield on the treasury, like what is the cost of that capital, is actually relatively low in terms of historical terms. So like the interest that the government is obligated to pay over time is relatively low relative to GDP, and certainly lower than where it's been in very difficult periods, most notably the late 70s, early 80s into the 1990s. And why that matters is because when we look at the debt servicing as a percentage of our GDP, it's relatively healthy. So it's about 3.55. This spike up is due to the increase in interest rates that we saw over, from 2022 to 2023, that federal funds rate graph that I showed before that went from 0 to 5%. That made the debt more expensive to service because it's a higher yield on these treasuries and T-bills that the federal government is issuing. And as rates come down, this should hopefully normalize, and GDP hopefully goes up as well over that time frame. And we should be in relatively back to maybe historical averages or below this kind of 3% threshold. But still a far cry from the 4% to 5% range that we saw in the 1980s. And what this really tells me is like we generate enough of our total value, our GDP, to service the debt that we're issuing. But that doesn't mean we shouldn't look at, maybe not having such a large balance sheet in terms of how much debt we have as a country. I think that there's a case to be made there certainly as well. But from an investor perspective, this likely isn't the thing that generates a recession. I'll close on the GDP and debt comment with the other side of this is where else in the world are investors to go, whether you want a currency or just a place to have safety in your assets. Like we have the title here, still the cleanest shirt in the dirty laundry pile for a reason. Like we have our flaws most certainly, but the dollar is still the standard bearer from a currency perspective, and from a capital perspective, that the United States still seems to be, and probably will continue to be, at least for the foreseeable future, the primary place that not only here in the United States but globally people invest in for both, appreciation opportunity as well as security. So let's talk about bonds for a moment before we get into the election. So what we're looking at here is something called the yield curve. The yield curve is important. You might have heard this. The yield curve is inverted, and every recession has been preceded by an inverted yield curve. So if you haven't heard that, I'm sorry for being the one to tell you that, but it's important to look at what's going on here. So I want to start with this red line. This is interest rates on treasuries back in 2022. So these are timestamps 1 month all the way up to 30 years. And normally speaking, a normal yield curve looks essentially like this, where the shorter duration, your 3-month treasury bills have a lower interest payment than say your 10-year treasury bills. And the reason is, I'll go back to the mortgage analogy. If you went out and got a 30-year mortgage, the interest rate on that 30-year mortgage is going to be higher, all things equal, than if you got a 15-year mortgage, right? The bank will probably give you a lower interest rate on a 15-year mortgage than a 30-year mortgage. And the reason is they're taking on less risk because you have less time to give them back the principal that they are giving to you. Same concept in bonds, right? So if you have a 3-month obligation to pay back, the government has 3 months to pay you back, chances are pretty high that they're going to have the ability to do that. A little less high that they're going to be able to do that over 10 years. So normally what happens in the bond market is your interest rate on those shorter duration things like cash, money markets, 1, 2, 3 month treasuries are going to have much less interest being paid to the holders of those bonds than somebody who is purchasing a 10-year obligation because they want to be compensated for the risk. Well, what happened in 2022 after this was the last normal yield curve, when we started to see inflation, interest rates spiked, especially on the front end, and inverted the yield curve where even these longer duration bonds, the 10 years and so on, were paying less interest than on an annual basis than your much shorter time frame obligations, which is the inversion of the yield curve, which is where you see this higher interest paid on the front end instead of the back end. And that's, again, a representation of risk, which was essentially the market was saying there's more risk because of inflation further out than there is short term. So let's get, or there's more risk, short term than there is further out because of inflation. The cost of things is changing. I need to be paid now because prices are going to go up in the future, right? And so what this means from an investment perspective going forward, especially if you're sitting in a position like we saw in that graph before that showed all the cash that investors have accumulated, that's largely, I think, due to the attractive rates that banks are able to pay that you can get in 3, 4, 5% on very safe assets. The likelihood of that continuing much longer, especially as rates start to come down, is, from our opinion, not sustainable. Our expectation is that the interest rate yield curve should normalize and this front end should come back down and be lower than where the further end of the yield curve is. So for our bond investors, what we're recommending is reducing our short-term obligations, reducing our cash positions, and getting longer durations, longer maturities for higher for longer income from our fixed income investments. And just taking advantage of where these rates are, because we think the entire yield curve will not only come down, but especially on the short end, we expect that to be lower than the further dates as rates continue to come down over the next 12 months or so. So let's talk about 11 days from now. We got an election coming up. Hopefully there's not much infighting in your family, maybe some internal anxieties based upon your value systems. We're not going to spend any time other than that on who the candidates are or even necessarily the policy, but to John's point earlier about what does the data tell us from an investment only perspective. Okay, so I'm not going to try and diminish either the value systems or the policy objectives that you might believe in, but more just from an investment paradigm, what do we anticipate happening? So John alluded to this before. So what we're looking at here is from 1933 to the end of last year. How has the S&P 500 done? And you can see relatively, regardless of political party and power from a presidential perspective, the stock market has gone up. There's a couple exceptions to that. We can talk through that, but overall, stocks go up and do that regardless of who is necessarily in charge in office. And if you were to ask us why this is, we would say like stocks don't care about red or blue politics. Investors only care about green, right? And there are ways in variety of different administrations to be thoughtful from an investment perspective. And what we also see from just a resiliency of the S&P 500, again, these are the 500 biggest companies in the United States. Like they have smart people that work there and they care about their bottom lines at each of these organizations. And they have an ability to navigate through the change that occurs both in a policy perspective to geopolitical risk. We've seen that, time and time again. What's captured here are world wars, global financial crises, currency risk. All of that is captured in here. Each one of these kind of light shaded areas are recessions. So in spite of all of this, what we see is earnings continue to grow and stock prices continue to grow. When we look at each individual candidate, president, I should say, not candidate, from a historical perspective, no matter how you slice it, for the most part, stocks have gone up on their time frames. Bush being the lone exception. We call this in the industry the lost decade. during his presidency, and his presidency was barbelled by two pretty historical components. One was the tech wreck that we talked about in 9/11, which really had a pretty substantial downturn on the front end. The tech wreck, I think, probably out of his hands in a lot of ways, followed by the end of his presidency with the global financial crisis. So not the two best things to experience over a 10-year period. Thus, this was the most challenging over that 10-year period. But as you can see, regardless of who's been in office, there has been pretty sustained, pretty consistent stock market returns, regardless of who's in power. And one thing that we see, it's interesting when I do client review meetings. This is a question that came up. This was actually my mother-in-law. I call this my mother-in-law test, because when back in 2008, she was not particularly fond of Obama. She made the decision that she was only going to invest in stocks when her political party was in power. Like, that was literally her investment strategy. So our team broke out this data. You can see here, during Republican presidents, only the annualized rate of return for U.S. Companies is 2.78%. So if you had $10,000 in 1950, it would have grown to $77,000 if that was your strategy. I'm only investing when a Republican president is in office. You would have fared a little bit better with a Democrat, but not as much if you just didn't make that decision at all. That 10,000 would have grown to over $3.5 or $3.4 million over that lifetime of investing. When we look at this, well, what if we just go to cash during an election year? They're volatile. The results aren't as bad from the previous graph relative to if you went political affiliation, but still substantial missed opportunity based upon a de-risking of a portfolio based upon the volatility of political environment. When we look at what the market likes, like what is the best outcome from an investment only perspective, I have to put a huge asterisk there. The short answer is a divided Congress, like a divided power, is the thing that is most appetizing from Wall Street's perspective, from investment returns. And I think there's a variety of reasons. One is predictability. Not much gets done when Congress and the presidency are not of the same party. You can see a divided Congress with a Democratic president, annualized 15% rate of return on the S&P 500, and 12% with a Republican president, and a divided Congress in the Senate and the House. And so that seems to be the most likely outcome right now. If I was to bet, I would imagine that, I don't know who's going to be president, but I'd imagine the Senate, it seems to be likely to be Republican. The House has a chance to be Democrat, just based upon data. But again, I don't know. That's pure NOAA conjecture, not necessarily Clark's opinion either. But what we're rooting for from an investment perspective is a divided Congress. That is our goal. If we look at the two most recent presidents, I think this can also be interesting. These dates are starting from the election period to when they lost the election. So, starting in 2016 on November 2nd. So this would be November 5th for us of 2024 when this new election comes in. You can see not a huge difference in terms of equity returns, stock market returns over this 4-year period between these two presidents. Very different human beings, very different policies. So why do we like this? I'd mentioned, why does this work? I think that the core reason is there's predictability in terms of policy, tax code, regulations, whatever it might be. Because generally speaking, politicians say a lot to get elected. And then what actually gets passed out of their agenda is relatively small. If we isolate just the tax talk from 2020 for Biden, there was a lot of different things that were proposed that I think if he had the power at a legislative level in Congress to do, a lot of this, more of this would have occurred, right? So I think we would have seen corporate rates go up. We would have seen tax brackets go up for the higher earners, up from 37 up to 39%. But the only change in the tax code in his presidency has been this 15% tax on reported book income. So, relatively small based off of the agenda or the ambition of the administration. And so When we look at what the big picture is, we look at the marketplace here and say, stocks are fairly valued. There's a case to be made for them to continue to go up over time. Interest rates are coming down, which should be a headwind. The labor market, or excuse me, should be a tailwind. The labor market is also relatively strong. It's showing a little bit of signs of weakness. That's where we're kind of examining from our portfolio's perspective. But still, even the data there is showing some resiliency. So there's strength in the economy. We see interest rates coming down, which should make both bonds and stocks more appealing long term. And in spite of some of the volatility or the angst in an election, it historically has not mattered from an investor perspective. So we anticipate that we'll see some volatility, certainly, but there should be more ups than down over time as our expectation. So the final unsolicited advice, get out, vote, turn off the news, if you will, unsubscribe from the blogs or whatever, wherever we're getting inundated with information. We got 10 days, we can maybe, relax a little personally. So with that, I'll let my attorneys and our legal team get our disclosures at you. And from there, I will pass it back to you, John. Thank you all so much for your time.
Thanks so much, Noah. And you're going to stick around for Q&A, right?
Yes, I will.
Beautiful. Okay. So now that we've gone back to history, I've got some real good news for you, but I also want to make sure we look ahead because, as I say, suppose this time is unlike anything we've seen before. And I want you to know that I mentioned to you that Daniel joined us in 2006, and we went to a presentation like this. And Daniel's really smart and he's good with math. So I took him to this presentation because the presenter was somebody I thought a lot of. And this is 2006, my friends. He had the unmitigated gall to stand before us and say, hey, you know what? I can't see the future, but we've already been through 50% loss. Let's be ridiculous and imagine there could possibly be 50% losses right around the corner. And on the way back to the office, I go, Daniel, that was scary. Nobody has talked like that before, but he raised a darn good question. You've been, just hired, and I've been looking at some technology that I think you can better evaluate than I, but we should be using this technology and then getting in front of clients to show them how they might be able to limit their losses. We did our homework. We put some packages together. We went to our largest account at the time, $10 million retirement account in January of 2007, and we made some suggestions. The folks who followed the recommendations, not everyone did, in 2008, who saw when that train was going to hit you upside your assets? Okay, I didn't either. But my point is that sometimes it's better to be lucky than good. We started in January of 07. The market dropped second time in the same decade, 50% in 2008. The folks that we went to and they made the decision to make some changes to their portfolio saw their losses in 08 less than 20%. Let's recognize that the market was over 37% in the red, and our vaulted Vanguard, everybody loves, was off over 42% in the red in 2008. So I'm going to ask Daniel to show us what he uses and how we think in terms of putting portfolios together so that you don't need to care who's going to win, who's going to lose. The question is, somebody's going to lose a whole lot of money. Does it have to be you? I want to set the stage real well because, look, right now, if you want to look at something, take a look at the S&P 500. What number do you want to look at? I'm going to give you the number to watch. Right now, we're watching 5860 on the S&P 500. And as we are talking right now, we're at 5812. This is kind of interesting because what we've seen just recently is the S&P 500 has bumped 5860 6 times. It hasn't blown through 5860 once yet. If it blows through, that's really good news. But if we see 5670, let's just go round numbers, 58, 59, 57, okay, just round numbers. That we'll see how that may unravel things. And just so that you understand, our research team is suggesting that stocks will get hit over 60% and real estate too. Okay, you want to talk more about that? That's a separate subject. But this is we can't predict the future, but we are very committed to helping people limit those losses as opposed to live with the losses. And what we're seeing right now, something you want to watch for, is the breadth That's with a D. How much breadth is there in the market? We've got the top 7 tech funds. They're leading the market. This has happened before, like in 00 to 02, and NASDAQ was off 80 and it took 15 years to get back to even. Okay. So we like to see more stocks participating in these high water marks, not fewer. When there are fewer, that's not a good sign. But speaking of signs, Noah said something that I want to pick up on about being the best shirt in the neighborhood. Let's go to The Economist, please, Daniel. And I'm going to, say to you, The Economist is not U.S. based. Okay, it's a good source. And what do they do? Well, they're in England and they've been around for a very long time. So I want you to see what The Economist just said a week ago about these United States of America, and this will make you feel really good. How about this? The envy of the world. That's a darn good source. And what do they highlight here? Stronger growth, richer, larger financial markets, energy independence. Okay. It's been a long time coming. So, where Noah calls us the best shirt in the laundry, we're saying we're the best house in the neighborhood. And by the way, that includes the US dollar. But this is an assessment of what the economist is seeing about these United States of America today. So spend some time sharing this information with people as they're pulling out their hair, going, the sky is falling. No, it's not. Okay. But we want to be prepared in the event it starts falling. So with that, Daniel, how do you use technology and how do you help people really see what they're doing, and what do you do to show them how they may be able to live with the losses as opposed to be stuck with living with the losses?
So there's two big questions that investors and our clients really have, two big challenges. The first one is really figuring out what their real goals are. Like, when can they stop working? How much income do they need? What kind of assets do they need? What kind of insurance do they need? And how much of it to protect their family? Those are real questions that people think about, but they don't really understand how to answer them. The second challenge is, how do you balance your risk tolerance with your investments? If you're going to own, let's say, for example, an S&P 500 fund, you have to be willing to see a 50% decline in any given year. We saw it twice, once in 2000, once in 2008. That's a real risk. If that's too much risk, how do you pick investments that are going to work within your risk tolerance? What happens a lot of times is people take these investments and they're doing great, and all of a sudden things turn around and they get scared and they sell out. Well, then they miss the upside when it bounces. So you got all that downside and you miss the upside. You whipsawed yourself. You really hurt yourself. And that's why average investors don't do as good as the markets, because they second guess their investments and they change their strategies. What
Let me
we
interject
do,
something real here. I'm sorry,
so
Daniel.
good,
Let me
good.
interject something really important here. The last 2 times we saw 50% losses, you were more likely younger. Is that fair to say? And you were more likely making contributions somewhere. And that loss, or those losses, were really what? A blessing to you, right? Because you're putting in money regularly. That's kind of like collecting shells. When the tide goes out, that's when it's safe. And then you collected the shells, the tide goes in, you got more shells. Prices went down, you got more shares, and then the price came back, you have more money. That's when you were contributing. And this is my problem with my industry, my friends. We tell you to live with the losses no matter what. You can live with them when the market's going down. Can you live with them when you're taking withdrawals? We had a referral. The son wanted us to look at his mom's account. Daniel took the portfolio, ran it backwards. And as she was taking withdrawals in 08, her account, this is a real situation, was off 70%, 7-0. Now, if you're taking withdrawals, particularly from traditional retirement accounts, what must you do? Your withdrawal rate has to do what? Increase a little bit every single year, no matter what. You cannot stop this. You must take the withdrawals, you must pay the tax, and the withdrawal rate as a ratio climbs every single year. So whereas a 50% loss once or twice was your friend when you're making contributions, it becomes your foe when you're taking withdrawals. And now we have baby boomers turning 78 this year. Clinton is one, Trump is one. Here comes 76 million people. Here we are, starting to have to or want to take withdrawals. Now it becomes very incumbent upon us to figure out how we might be able to limit those withdrawals. Sorry, Daniel.
That's fine. So how do we address those challenges for our clients? Well, The first one is with our experience and our planning. We've been through all these questions. We've planned all of these things for our clients. So we're going to know the questions that need to be answered and how to answer them. Then we're going to model them for you in our financial planning software that you can see and you have access to. And how do we build portfolios that work within your risk tolerance? It's our technology. We use modern technology that's going to track how much risk you're taking, and we're going to include things with that are actively managed, like what Clark does, and we're going to diversify more than you have before. By including the diversification, real diversification, you're going to balance out the risk of your portfolio, and that's what's really going to set you aside from your peers.
And notice this, the industry still recommends, and how old you are, whatever you're doing, is 60-40. Okay, 40-60, 60-40 stocks, bonds. And then they tell you you're diversified. Well, maybe you are, but you could be more diversified. And one of the ways we look at that is Yale endowment. And the first thing I noticed, we study this, Yale once a year, we go through, they give a report. You have to pour through it. It takes some time. But what I notice is that the Yale endowment, $40.7 billion, the exposure at Yale in US stocks is all of 3%. Huh? Not 30, not 40, not 60, not 70. When we make bets, how few, whether it's stocks or real estate or bonds, how many of us are at 3%? Most of us are well above 30, okay? The second thing we notice is we count 6 to 7 different asset classes. So think of it as 5, 6, 7 legs underneath your portfolio stool. So it gives you kind of a picture of what we're talking about when it comes to diversification. And there's some instruments other than traditional stocks and bonds that we're very fond of. Everything is customized, so I can't really explain what I'm trying to confer to you, but that's why it would be important for us to sit down, even for 15 minutes, and see how we might be of value to you in your getting a second opinion. But again, we don't want you to think you have to live with the losses. We want to show you how you can limit those losses.